When it comes to 529 plans, the question that I get asked the most is which 529 plan should I choose? Now, I've done that on other videos, and we're not going to tackle that question today, but we are going to tackle the second most asked question, and that is, which investments should I choose inside of my 529 college savings plan? So that's what we're going to talk about in today's video, and I'm really going to keep this as simple as possible. These are going to be my own opinions and how I invest with my own kids' 529 plans. And just to say right off the bat, there's no right or wrong way to do this. There are a lot of investment options inside of these 529 plans. And just because I'm not using it doesn't mean that it's not right for you. So the two strategies that I'm going to talk about or tackle in this video is going to be the target date funds, also known as the target enrollment funds. And those are the funds that get more conservative as we get closer to that enrollment date, the time your kid goes to college. And I'm going to compare that to an individual portfolio. And I'm going to keep this individual portfolio really simple and only use an S&P 500 fund. So we're going to compare the target enrollment funds to just using the S&P 500 funds found in most 529 college savings plans. So I'm going to use the Florida 529 plan as the example, but basically it's going to be very similar, if not virtually identical to other 529 plans all around the country. And of course, if you have questions on this, let me know in the comments down below, but let's go ahead and pull it up on the screen. Let's go ahead and get into it. So here is the 529 college savings plan for the state of Florida, and they have a prepaid plan and a savings plan. The savings plan is the one where you're just going to save into it and your investments grow. Those are the investments that we're going to talk about. So if I scroll down, we're going to see three investment options. And I think this is where a lot of people kind of get, I don't want to say misled, but think that this is the easy button all the time. But I think you're going to see that it's not quite always the easy button. So here's the simple option and here's the advanced. Those are the two that we're going to deal with. So the simple one is going to be these target date funds, and the advanced is going to be choosing your own fund. And like I said, we're going to only choose an S&P 500 fund. So if we start out by looking at, see here, they even have it listed as the most popular plan. So that's all just marketing stuff to get you to say, hey, this is what I should choose. So if we click on this link down here, it's going to open up this PDF. And if we scroll down, we're going to see the breakdown of all of these funds. And if this feels really complicated to you, don't worry. Hopefully I can break it down in a way that you can kind of understand what's going on here. So these are all of those portfolios. And again, it might seem overwhelming looking at all of them, but realistically, it's only going to be one. And it's going to be the portfolio that you start with, given the year that or the age of your child, and then the target enrollment year. So let's say that we're starting here. This is going to be the most aggressive of these portfolios. And it's basically broken down by equities or stocks as more aggressive, and then all of this blue are different types of bonds. And then we have a money market fund here. And you could see the breakdown in each one of these funds in the year that you're choosing. And basically what happens here, if you were to start investing in an enrollment year of 2042, it would start out with 51% in this fund, 34% in this fund. You can see all the breakdowns. And over time, it gets more conservative by putting more of your money inside of the bond portfolios. Again, less risk, more conservative. That's the idea here. So your portfolio will change over time without you doing anything. All you're going to do is direct deposit into this monthly or whenever, and that's the way that this is going to basically run. So I took all of these numbers and I put them into a Google Sheet, which I'm going to show you right here. Let me go ahead and pull it up for a second. I put them all in here. These are the same funds, the same breakdowns, same years here. We see all the percentages. The only thing I did different here was I pulled out the rate of return over the last 5 years for each one of these funds. So you could see the ticker, and that's called a ticker right here. If you put that into Google, you can pull this fund right up. So it's VSMPX, and we'll go back to this PDF right here. You can see I pulled it right from there, right up there. You can see that right there. So that's how I did that here. Now, to figure out the rate of return over time, all I did was multiply the percent that was in that fund by that 5-year rate of return. So we're just trying to compare apples to apples here. That's what we're trying to do. I did all the math, so you don't have to do anything. I'm just explaining what I've done. So if I scroll to the right here, you can see the portfolio returns just by finding those averages. And that rate of return is going to obviously decrease, or maybe not obvious, but it decreases over time because we're being more conservative. If you don't have your money in stocks and you only have it in the bank, you're obviously going to get a lower rate of return in the bank than you would in the stocks over time. Not every year, but over time. And that's what this money market is over here. You can kind of think of it in terms of that. So we get more conservative as we get closer. In theory, yeah, that makes sense. But let's go ahead and compare it to an S&P 500 fund that you can find in one of these portfolios. So over the last 5 years, I pulled one that did 13.57%. And you might think, hey, that's a really high rate of return. Again, we're comparing apples to apples. So this would be the same thing. This fund would have a high rate of return relative to likely how it would do over longer periods of time. But again, we're keeping it apples to apples when we're running these numbers. So I put it in as we're going to start at day one when your child is born, and we're going to go right through enrollment. And we're going to save $500 per month every single month. So that's 12 months there. And we're going to get a 13.57% rate of return. And that is going to be this S&P 500 fund right here. And we can see side by side how we would do over the long haul. Now, a couple of things to point out. First, this is an annual compound rate of return. So think of it like an average, so to speak. So 13.57, you're getting that every single year. So you see no down years. We know that's not reality, but over long periods of time, you're going to get a positive rate of return in the S&P 500. That is what history has shown us. So that is what we're applying here. Now, what jumps out at me is how drastically better off we would be investing in the S&P 500 fund than we would in this glide path or target date fund, as they're called. So we almost have 3 times the amount of money. That's a huge amount. And even a downturn in the market over here would still net us quite a bit more than we would have inside of this target date fund. That is the first thing that jumps out at me. Now, even if we were to drop this rate of return, which I can just plug it in. We have 13.57. Let's say I put in 10%. We'd still have significantly more. If I brought it to 8%, we'd still have quite a bit more inside of that portfolio. Now, what is a reasonable rate of return that you can kind of think for the S&P 500? A lot of people want to put between 8 and 10%, but let me show you some math. So some data. So this is the S&P 500 over time. So I have this whole chart, and it looks super complicated, but it's really not. So if we just scroll down here, we can see, what did the S&P 500 do from 1926 to 2022? 10.1%. Now you might think, well, times have changed. That's what I'm always being told, although they're really not. Everything is exactly the same with the stock market every single year. So we have the highs and the lows. So we can see that any 2 points on this graph or on this chart, let me pull this up, get rid of that. I don't know where that came up. So if we put it in here and we come here, we can look at 2022 all the way to 2011. That's 15.2%. So you can see all these different rates of return. Even if we put in atrocious years like 2008, down negative 37%. Again, if we came back to this spreadsheet right here, if we were down 50%, we'd still be ahead. You'd have to be down way more in order to not actually be able to fund that same amount that you would in the glide path with all positive numbers throughout. So to me, that is a huge amount, so much so that I would rather invest in the S&P 500 fund. Now, this doesn't mean that it's going to be right for everybody. And here's what I would think. So for me, I think of it as I'm not going to save 100% into my 529 college savings plan for my kids. I'm going to have money elsewhere that's also going to help fund school. So it's not just going to be this 529 plan. If we get close to the enrollment date and we just have a series of terrible years, I'm also going to make the decision of whether or not we want to use those 529 plans for those kids. Now I have 5 kids, so that, again, that's going to change the dynamic. So maybe I use more of the cash that I had for my youngest one, for my first kid going to school, or for my twins going to school, two of them that are the oldest, they'll go to school first. I have that flexibility in order to do that. If you only have one child or two kids, that might change the dynamic. Another thing that I would think about too is with the 529 plans is you don't have to take the money out. So you can keep it in there and maybe use it for your grandkids. That's another thing that I would be okay with if that occurred. If it was a down year, say, you know what, we're just going to keep the money in there and let it recover and we can use it for our grandkids. Again, I'll pull money from other places in order to fund school. So there's a lot of different ways you can look at this. Now, if you're funding school, that means you should already be also on track for your own retirement. So in essence, it should be excess money. So if it's not, you need to rework your financial plan, but that's for another video. So for just sticking with this, those are the decisions that I would make if it was a down year. Now, if you also look at these numbers, if we get closer to that enrollment date, say 3 or 4 years out, we start to understand or get a better idea of where our kids might go to school. So then we can get a better idea of those costs because school costs are all over the board. So if we're here and I know, look at this, $338,000 and we're still in year 14, so we still have a little bit more ways to go, but we would have already reached the goal if we determined that we only needed, say, $218,000. So we would have reached that goal very early on if we started right away. So again, that's where I say that it's going to be different for different people, because if you're not starting when your child is born, maybe over here, and this is zero for you, maybe you have to play a little bit of catch up. So what would I do with that information? I would say run the numbers as if you were going to achieve an 8% rate of return, because that will make it so you have to save more, and you save more with the idea that maybe you'll get better than an 8% rate of return. And that's what I would do right here. So I would have run these numbers day one with the idea that we're saving $500 per month every month, with the idea that we're targeting an 8% rate of return. And if we had got this 13.57% rate of return, hey, that's only going to be, we're just going to be better off. That's it. It's a bonus. And maybe later on, it'll ease that stress financially, saying, hey, you know what? We got to our goal a little bit earlier than we had anticipated. So that's where I would go with that. Now, let me show you some other data points to help with all of this staying the course bit. And that's really the elephant in the room here. It is staying the course. First, let's look at this one. This is the bull and the bear market chart. So much of the media, every time you turn on the news, the sky is falling. That's what we always hear. But in reality, most of the time, the market is marching forward. And you could see that here by all of these time periods of the blue going up and up and up. It's only these small pieces where the market is going down. Now, sometimes those small pieces could be a year, year and a half, 2 years. I mean, you can see that right here. A year and a half, 9 months, 1.1 years. That time frame sometimes doesn't feel like that because we don't know that it's going to be just 1.5 years. We don't know if it's going to be 2 or 3. And again, with the news and everything else that we hear, the sky is always falling. So we never really know. We always think that on the horizon, next month or next quarter, or next year, the market's going to fall apart. And somehow it just doesn't, and it does better. And then when we least expect it, the market does take a little bit of a downturn. But the numbers don't lie. Over time, the market goes up. That's what history has shown us, and that's what we have to rely on. Now, looking at this other chart here is from year to year. So the gold down here is the lowest point, or the yellow down here is the lowest point. I don't know why that keeps popping up there. The lowest point in the year. So for example, if we look over here to say 2009, probably is a good year to show. At one point in the year, the market was down 28%. But if you had stayed the course for the full year, you would have been up 23%. Now, again, we don't always know how the market's going to finish. I mean, even in 2008, the worst point of the year was down 49%. But if we just stayed the course, we'd be down negative 38%. Now, this is much easier said than done because there's a lot of mind games. A lot of investing has to deal with the psychology of it all, whether or not you're actually going to stay the course. Now, if you're not somebody that can, that's why I said in the beginning of the video, maybe it's right for you to use a target date fund and just forget about it, because you will have less highs and less lows. So it's going to be more conservative over time. So maybe that is right for you. But if you're armed with this knowledge and understand, hey, the market's going to go up, the market's going to go down. But if you stay the course, then the market will come up over time. Again, I say this a million times. That's what history has shown us. So that is what we are relying on. So every single one of these years that we're looking at, the market performs. It almost is like clockwork. At some point, there's the worst day in the market or the worst point in the year, and then it recovers. And even if this is the only place that you were going to save, or if it was for me, this is the only place I was going to save, and I didn't have any other money, and I didn't have any aspirations of my grandkids having this money, and I wasn't going to use any of those other strategies, I would still look at those target date funds and kind of look at them and say, well, why do they have bonds day one? Like for 18 years out. If you're not going to use this money for 18 years, why is there bonds in the early years? That doesn't make a whole lot of sense. I think it just gets to that point because of the laws and the regulations and people just looking at this stuff and saying, well, we need more conservative options, and not thinking like, okay, well, we don't need to go to the extreme of saying we have bonds in a portfolio that we're not going to touch for 18 years. That doesn't really make a whole lot of sense to me. So that is why I invest the way that I do. If you watch some of my other videos where I actually go through my kids' 529 plans, I've put them all in the S&P 500 funds because I just want to set it and forget it. I don't want to deal with it. You know, you just put it in there. It's the 529 plans. There's not a whole lot you can do with them. There's not a whole lot of there's no individual stocks in them. So you just pick the funds. They're already diversified. The S&P 500 accounts for 80% of this country's market capitalization. So that's basically like most of the returns of our stock market. So we also have to understand too that schools are inflating faster than regular inflation. So if you think over the last couple of years that inflation has been rampant, just look at schools. I mean, they're the worst offenders of it all. So typically it's about 6-7%, and regular inflation is typically at 3%. So over time, of course. So you just have to think of that when you're investing in a 529 plan. So hopefully this has helped. If you have any questions on this stuff, let me know in the comments down below. If you enjoyed the video, be sure to subscribe, and we'll see you on the next one.